The history of the stock market, from ancient trade to modern finance. Imagine living on a planet where stock markets do not exist. No Wall Street, no Nasdaq, no Euronext. No shares of Apple, Nvidia, or ASML. No Warren Buffett or Charlie Munger, who became billionaires through investing. For centuries, even millennia, this was exactly the reality. So, how did investors transition from trading grain and spices to using mobile apps to buy shares of trillion-dollar corporations? Our story begins long before the establishment of the first stock exchange. Let us travel back to the earliest civilizations. In ancient civilizations such as Mesopotamia, Egypt, Greece, and Rome, merchants pooled their financial resources to execute their trade expeditions. A merchant might need funds to launch a ship bound for dangerous oceans, while the wealthy could provide capital in exchange for a share of the future profits. This concept was a true revolution in sourcing finance. Instead of a single individual bearing the entire potential loss, multiple people shared both the risk and the reward. Although these mutual agreements were different from today's stock trading, they planted the first seeds of modern investing. As time progressed, trade expanded across Europe, Asia, and the Middle East. Throughout the Middle Ages, merchants designed increasingly sophisticated financial systems. Bills of exchange, commercial credit, and partnerships fueled the growth of international trade. Port cities like Venice, Genoa, Antwerp, and later Amsterdam became vital trade hubs. Yet, a massive problem remained unsolved. Long-distance trade expeditions required immense amounts of capital, and a single failed journey could instantly bankrupt even the wealthiest merchant. Then, a development occurred that would alter the course of human history. By 1602, the Dutch East India Company, known as the VOC, was established in Amsterdam. To launch its massive voyages to Asia, this company required staggering amounts of capital. Instead of borrowing from a few wealthy individuals, they executed a different strategy. They decided to broaden their capital base by offering ownership shares of the company to the public. Thus, for the first time in history, ordinary people could own a small piece of a company with their modest savings and receive a share of the profits. This event is recorded as the first initial public offering, or IPO, in the history of the stock market. Shortly after this development, investors began demanding a dedicated venue where they could freely buy and sell these shares. As a result, the Amsterdam Stock Exchange was established. Most historians accept the Amsterdam Stock Exchange as the world's first modern stock market. Of course, the extraordinary developments did not stop there. Investors were not just buying and holding shares, they were constantly buying and selling them. Stock prices rose and fell, and this phenomenon gave birth to speculation. While some investors grew rich overnight, others lost everything they owned. This scene might sound familiar to you. Within just a few decades, many financial instruments we still use today emerged. Options, futures, and short selling were just a few of them. The foundations of the modern stock market were now fully laid. Over time, stock exchanges spread across Europe. London established its own exchange, followed by Paris, and new financial institutions emerged in various regions of Europe. On May 17, 1792, 24 brokers signed the Buttonwood Agreement under a buttonwood tree in New York. Over time, this agreement transformed into the New York Stock Exchange, which we know today as the NYSE. With the Industrial Revolution, the number and variety of corporations grew rapidly. Railroads, steel companies, banks, and manufacturing giants required massive capital. Stock markets became the engines for corporate and economic growth. Investors could now become partners in giant firms operating nationwide. By the 19th century, stock trading evolved from a niche activity into a global financial system. By the 21st century, new technologies, communication networks, and global trade caused stock markets to grow at an unprecedented pace. However, this growth brought along greater risks, massive rewards, and devastating crashes. In 1929, the Wall Street crash triggered the Great Depression. Markets worldwide collapsed, and millions of investors lost their life savings. In response, governments introduced strict regulations to protect investors and stabilize the markets. Thus, the era of modern financial oversight in stock markets began. In the subsequent periods, markets gradually recovered and grew even stronger. Computers swiftly replaced paper ledgers, and electronic trading pushed chalkboards into history. The Internet opened investing to ordinary, retail investors. In the 21st century, smartphones and apps carried the stock market right into everyone's pocket. Today, trillions of dollars are traded every single day in global markets. People can buy and sell shares of companies on the other side of the world in a matter of seconds. Yet, despite all these technological advancements, the fundamental logic has never changed. The exact same idea that inspired ancient merchants thousands of years ago continues to live on today. This journey from ancient trade routes to modern stock exchanges is ultimately a story of human passion, resilience, entrepreneurship, and the desire for progress. As long as humanity exists, this story will continue to be written. If you enjoyed this journey through the history of the stock market, don't forget to subscribe to the Stock Market Historian channel. We will continue to explore the stories that shaped world history together.